I do believe that money printing matters. People going into the store are going to be paying more for stuff. They're going to be upset, and they vote. And that'll be interesting to see how the powers that be respond.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Lobo Tiggre from the Independent Speculator. Lobo, thank you so much for joining us today.
Happy to be back with you, Elijah.
It's great to have you. And well, yesterday we just saw the Fed raise rates the first time since 2018. Now, it doesn't seem very impressive. It's only a quarter-point rate hike. That's what markets were expecting. We saw a rally in pretty much across all markets yesterday. What is your take on the Fed's decision? Will it make any difference?
Well, clearly not. You have 0.25%, 25 basis points when inflation's running 8%. And to be fair, Powell himself says this isn't going to have any immediate impact. It's going to take time. Basically what he's saying is they're going to take a couple of years to normalize. And despite having supposedly retired the word transitory, it is clear that they are still expecting inflation to largely correct itself with base effects and the supply chain bottlenecks opening up. They're expecting inflation to come down. You look at the new dot plot and they're looking at 2 to 3%, 3 max, and then settling down to low 2% and going forward. So they're clearly expecting inflation to come down by itself. So they're not going to have to raise rates higher. People keep saying, why don't they go Volcker? If inflation is 8%, shouldn't the interest rates be above 8% to tame inflation? Well, this is why. It's not that they don't know what Volcker did. Again, to be fair and to be accurate, really, maybe fair isn't the right word, but to be accurate, Powell has cited Volcker. He knows well what Volcker did. He just doesn't believe that's necessary. Or he says that. I mean, that's the game plan. Who knows what they really think and what they're able to admit and say on TV. Because if they say, holy cow, we're in trouble, that causes trouble. He can't say that. So whatever is going on between his ears, the game plan explicitly, what's being said, clearly says inflation is going to take care of itself. Now, many of us, particularly those of us who ascribe price inflation to monetary inflation, are very skeptical of this. But here's the thing, and to give credit where due, my fellow Puerto Rican, Peter Schiff, was the one who pointed this out in his podcast. I didn't have this data point in my mind, but it's quite striking. The bottom for gold in this cycle was late 2015. A lot of people like to talk about the Powell pivot and things taking off after 2018. That's true that there was a marked increase in monetary metals, particularly gold after that. But really the bottom was late 2015. And what happened then? That was actually the last time the Fed first started raising rates. And according to Peter, I haven't checked this, so I just saw this or heard this right before we came online, so I haven't tried to check it. But what he said was it was to the day. It was the day of that initial rate hike in 2015, in late 2015, that was the bottom for gold for this cycle. So does that prove anything? I don't know, but it's an interesting data point, Elijah. Think about it. Fed's raising rates for the first time in years. It's only nominal. It's not really going to affect inflation. Even they say that, but it is a signal. It is a directional change, and prices are determined at the margin. So really interesting. And final point on this, people who've been in these markets for a while, they know that, what really matters is real rates. So directional changes matter, even if real rates remain profoundly negative. If they might be a little less negative, that matters. So people have to pay attention to this. But we also know is that this gets priced in advance. And so you frequently see the rumor of, buy the rumor, sell the news, the rumor of rate hikes being very bad for gold, and then the actuality being good, like 2015. And in my mind, the really clear example is 2004, 2005, where you had rates going up in gold, for years, a couple of years. It was really striking. So that's actually the game plan that I expect here. I expect the Fed to remain behind the curve. We can talk about why, but I expect them to remain behind the curve. I expect real rates to remain profoundly negative. And as you and I speak, gold is actually doing that. We closed slightly positive after the initial knee-jerk reaction. We actually closed positive after the Fed announcement. And as you and I speak, gold's around 1940, 1950. It's having a good day. So it fits the playbook perfectly. We've seen this before. Oh, the Fed's going to raise rates, sell gold. Oh, the Fed has raised rates, but it's behind the curve. Buy gold.
You mentioned how Powell knows what Volcker did in the 80s. I mean, if we look back, the last time that inflation was this high, rates had to go to, the Fed funds rate had to go to as high as 19% to get inflation under control. So this quarter point rate hike, it seems like means nothing. And as you're mentioning, it seems like the Fed is assuming that inflation is going to get under control by itself. But why do you not think that that is the case?
I do actually expect the rate of increase to moderate. When you have such high comparables over the last year, that's a real thing. That's a real phenomenon. That base effect will happen, and it raises the bar for the comparison year over year. But that doesn't mean we're going to have deflation. That doesn't mean that prices are going to stop going up. It just means that comparatively, it's going to be hard for them to increase as much this year compared to last year. So some of these things are true. And to the degree that the supply chain bottlenecks are creating, temporary, I'm not going to use the other T word, temporary supply shortages that are pushing prices up. As that clears up, that should matter. These things do exist. They're real. But so does money printing. We also know that. What the Fed's done to the balance sheet, the national debt. I know it's, I'm showing my white beard here to even care about the national debt. But the fiscal policy that has been, and I think is not done, coming from Washington. And these things really do matter. And they take time to percolate through the economy. I mean, Friedman famously measured it as averaging around 18 months. Well, 2020 is, parts of it are less than that ago, and it's an average of 18 months. So, it takes time for these things to work through. So I think it's, you could say, Powell's stupid or ignorant. I don't think so. I think he can't say the full truth, the whole truth, and nothing but the truth. So he chooses the most optimistic things that he can say to avoid panic. But, nobody could have seen the high inflation coming. I think they had a pretty good idea it was coming. And I just don't think they can be fully honest with the public right now, or they'll create panic. So I think we're going to see persistently higher inflation. It's funny, they're even messaging that. Like they're saying, well, in Europe, they're talking about peak inflation next month in April. Powell, in his talks yesterday, he was saying, peak by this summer. That means several more months of increasing inflation, which is really striking to hear coming from him. But they're messaging that in advance. Now he can say, if inflation's higher next month, he can say, oh, well, we said that's going to happen. So, we expected this. It's normal. It's part of this peaking process. Moving the goalpost on us again. But it's, we'll see. I do believe that money printing matters. And I suspect most of our audience does as well. So I'm just not going to belabor that point. I think we're going to see it this year. I think the Fed's going to try to dismiss it by saying, oh, yeah, we said it would be a while longer before it peaks. But at the end of the day, people going into the store are going to be paying more for stuff. They're going to be upset, and they vote. And that'll be interesting to see how the powers that be respond.
No, we're also seeing, as you've mentioned in recent articles, that there's a divide being created between the East and West, obviously having to do with the Ukraine-Russia war and sanctions and all that. How is that going to impact inflation and the financial system?
Right. So let's distinguish between short-term and long-term here. I think this is really important because obviously, you put a sanction on something, you ban imports, you change things. Somebody needs to scramble and figure out a new supply chain. Something like oil, for example, is literally a liquid asset, right? And it's fungible. If the Russians don't sell oil to the United States, they can sell it to the Chinese instead. And then the Chinese won't buy that same oil from somewhere else, and the United States can. So these things can be moved around, but not instantaneously. If the Russians are talking about selling more of their gas to China as well, but that pipeline has to be built first. That's going to take a couple of years. So in the short term, and we're already seeing all kinds of wonky things. The poster child for this right now is the price of nickel, which doubled in a day on a short squeeze on the LME. That's the sort of thing that we can expect from things breaking, suddenly changing the rules of the game in the short term. But that will settle out in time. New pipelines, new supply chains will be worked out, even if the sanctions stay on, and they may not. We'll see what happens. But overall, going forward, it's clear that even if when the war ends, even if sanctions cool off, which they may not, the West wants to punish Putin. So even if the war is over, I don't think there's any reason to assume that the sanctions will go away. And they're talking about putting more on. So this East-West divide is just getting started. The long-term implications, and I think investors do need to keep this in mind. Now, there's near-term noise, and then longer term, it makes the global economy less efficient. Even if you have liquid assets that will root around, and the supply of the oil in the world won't change, it'll be less efficient. It can't flow via the most efficient path between lowest cost producer and best bidder. It will flow by what's allowed by geopolitics. So just by definition, that makes everything less efficient, which means more expensive, which means, whatever prices would have been, they're going to be more going forward. I can't tell you how much. I don't think anybody could. But do expect that. The global economy is going to be less efficient. We're going to see higher prices. And, so there's a clear advantage if you have customers in the West and you're producing one of these materials that now would have been produced more cheaply in the East and is now going to be going to Eastern consumers, then you have an advantage there. And that will be, I think, a durable advantage for investors to look for going forward.
How do investors take advantage of that going forward?
Well, stock selection matters, picking the type of producer that can benefit from this. The details will be infinite, Elijah. I don't know if I can spiel off a bunch of things. You could, roughly look for, say, in the uranium space. Uranium prices are finally getting up to close to incentive levels for people to start producing again. Now, uranium hasn't been directly sanctioned. There is language in the latest executive order that seems to prohibit new transactions in energy commodities, which could apply to uranium. But the current supply has not been touched, and this is just Russia. But the world's biggest and lowest cost producer is Kazatomprom, close ally of Russia. About 50% of their output goes through Russia, through St. Petersburg, and they have alternative routes, but again, less efficient and so on. So it remains to be seen what the actual long-term impact of this will be. But if you've got uranium not in that part of the world, then you have a clear advantage bringing it to Western markets, let alone if you're if you're Canadian or American or Australian, the sort of English-speaking brethren there that help each other out. So I could see, a lot of those companies and those projects already trade at a premium, but this is why. And that premium, one could say, is now being seen to be deserved. And going forward, as this new Iron Curtain settles in and solidifies, those types of companies could be best positioned to benefit. And of course, it's not just uranium. I'm just picking that as an example because it's so clear.
You mentioned with respect to the uranium market that it has, the price has increased recently. Also, we saw oil increase. Your take on this increase, and it seems like energy prices across the board.
Yeah, well, clearly Russia's a major energy exporter. Energy prices are up, no surprise. Oil's triple digits. Does it stay there? I don't know. I mean, a lot of this depends on how the war goes and how long it goes and what other sanctions. Anybody that makes a price projection now based on any model whatsoever could be forced to rejigger their variables and assumptions tomorrow. So it's really, I just don't think anybody should be making price projections now at all. It's not just unknown or uncharted waters. It's constantly changing day by day, moment by moment, what your variables are. So it's just kind of silly. But the reality is that this new Iron Curtain, this conflict, between East and West, which very significantly has China taking Russia's side. They're kind of sort of trying to tread a middle path, but you don't call the United States the empire of lies and reaffirm that your relationship with Russia is rock solid if you're not taking sides. I mean, sorry, but that is taking sides. Now, they're going to want to limit the damage from that. They're going to want to continue doing business with the West, of course. And frankly, sanctioning China the way the West has sanctioned Russia would, that would be kind of economic suicide on both sides. I mean, that would be so big, basically bring the global economy to a standstill almost. So I'm not predicting, total division of two hemispheres of the world that do no business with each other. Clearly, there'll have to be some business, and we'll see what happens. But in that context, it makes sense that energy prices will remain elevated. And so we'll see, Elijah. I'm not going to give you a price projection. Is it going to stay above triple digits forever? Well, clearly not forever. We still have the electrification story. Is it going to stay above triple digits this year with the conflict still ongoing and the new sanctions coming in? The odds, I think, pretty good. I got to tell you, I'm nervous about saying, I was going 150 or 200 or whatever, buy more now. I wish I had bought more at 50, right? But it's too late for that now. So all I'm going to say is the markets have priced a lot of negativity in. And so while I'm sympathetic to the idea that ongoing damage to the global economy could push prices higher, it's not a sure thing. And OPEC will, even if it's not OPEC plus, OPEC minus will try to pump more. I think, they're still supposedly expanding their production. They haven't been able to keep up, but maybe now if they lose their plus partner there, they'll see it as a green light. We can pump more and make more money without hurting prices. So we'll see, Elijah. All I'm saying is, it's a bit dangerous to assume, it's going to 150, it's going to the moon now. It's already gone up a lot, and that argues for a bit of caution here.
And it's also going to impact the mining sector, as you mentioned in a recent article you wrote, that people need to be careful when investing, even in precious metal miners, that inflation and rising energy costs are going to impact them. So it's not just a one-to-one. It's not just as simple as if precious metals rise, then the mining stocks rise as well.
Right. Now, commodities do tend to move in these super cycles. So you have higher oil prices, you have higher gold prices too, typically. So in general, inflation is great for commodities producers. It's great for gold and silver miners. I get that. I'm not disputing that. All I'm saying is that you still need to pay attention. And if your gold miner was marginal, and suddenly his energy costs have gone up, if you're burning diesel fuel somewhere 5,000 meters up in the mountains in the Andes, your fuel costs just went through the roof. If we'd been having this conversation 2 weeks ago, your fuel costs would have been about double over what they were a year ago. Right now, they're only up about 50%. But that's still a lot. And you're going to truck that fuel up there. I mean, it is a serious issue with your operating capital. And of course, wages are going up, reagent, lots of prices are going up. So yes, rising commodity super cycle is great for your top line. All I'm saying is make sure that you pay attention to the bottom line too. Watch out for companies that are seeing their margins squozen, and beware of that. That should be a selection criteria as you're buying. Who is able, best able to keep their top line rising ahead of the bottom line. And that's really the easier part. The trickier part here, so that's OPEX. Watch out for OPEX rising and squeezing your margin. The tricky part is CapEx, because CapEx, you can't update that on a daily basis. You do a feasibility study, you do a full bankable feasibility study, and you build your mine. It usually takes you some time after the feasibility study. If the permitting is based on the study, you have to do the study first and then get the permitting. And usually you need the permits before you can raise the money to build the mine. So it takes time to get all these ducks in a row. By the time you're building the mine, your feasibility study, if you're lucky, it's only a year old. And a year ago, inflation was much lower. A year ago, basically all of the costs in any feasibility study would be lower than what they are now. Now, a good engineering firm will put a contingency factor in there. They'll pad some of the costs for inflation anyway. But all the inflation assumptions used a year ago are now wrong. The contingencies built in that might have looked conservative before are now no longer conservative. So I'm not saying that, that it's, run for the hills, nothing is safe, but I'm saying be very careful. For the audience out there, the takeaway from this, and by the way, there is a free article. If you go to independentspeculator.com, you can look for this. It's one of the most recent ones on the homepage. Inflation is great for commodities, but not necessarily all miners, is the name of the article. Key point is, if you've got a feasibility study that's more than 2 years old, don't trust it. If you've got a company that's building a mine on a feasibility study that's old and they haven't updated it, make sure they're posting regularly if they're on budget. If they're not saying anything about, they might say, oh, we're on time, we're on schedule. But if they don't also say we're on budget, beware. And beyond the mine builders, just everybody, you've got ongoing capital, you've got marginal producers, watch out for people that are exposed and vulnerable to increasing costs, both on the OPEX and CAPEX side. I think this is not a time to just be passive or buy a fund that has a bunch of miners. You need to be selective. You need to look at who's exposed to these costs, both OPEX and CAPEX.
Now, we saw last week an incredible move in both gold and silver. Gold pretty much right at that all-time high back from 2020. So your take on what we saw last week and the pullback we've seen since then. It seems to me that the markets, gold and silver, are still acting pretty strong and pretty bullish at the moment.
Yeah, I would agree with that last statement. That my fellow gold and silver bugs are going to probably hate me for saying this. Call me Darth Silver again here. But clearly the spike last week was driven by the war, right? And that doesn't last. Even if the war does last, that sort of fear and tightening, that doesn't last. And we saw this the last time. In fact, specifically the last time Russia and Ukraine had a conflict. Over the months when that started up in 2014, we saw gold rise 17% over the months. And that was a good rise. And we blew that away this time. So, and then it went into reverse as that conflict ended and things cooled off. So before you hate me, before you stop listening, remember that the underlying trend, I wasn't buying gold because it's a war hedge. I was in the gold and silver trade because of the inflation conversation we've talked about and how very far behind the Fed is and remains, with a 25 basis points, ridiculous hike in the face of 8% inflation. That's why I like monetary metals right now. They're doing what they should be. I think it's fantastic that gold and silver are up after the Fed raised rates. It really confirms our thesis. So that's the bedrock here. So on top of that, you get a scare, you get a war, you get a typical knee-jerk reaction into the safe haven aspect. And those never last. Those are always fleeting. So I don't get too excited about the new peak that we saw with the war news. It's typical. It doesn't last. It reverts to trend. The good news, though, is that the trend was upwards before that. So if we have a spike above the trend, we go back to the trend, we're still going higher. As you and I speak, we're close to 1950. That sure beats the 18, whatever it was, I think last time we spoke. So, well, let me put it this way. Here's a more positive thing I can say about it, Elijah. There were a lot of people who thought after the peak in 2020 that was it. That was the top. And gold's going back to $1,000. Or a certain economist I won't mention was sure it was going back to $700. That prediction he's been making for since 2009 or something. So in the face of that, that was it. That was the peak. The fact that it wasn't, the fact that we've already come back to that, and I just think that's tremendous news. It simply wasn't true. We can say it's a measured, documented fact. Looked at the chart, that was not the end of that market. And the trend right now is really strong. I'm very bullish. I'm looking to go shopping again, Elijah. If anything, I hope that, this news of a peace, a truce, the end of the war, and gold and silver drop dramatically, because the stocks will drop even more. And I would just love to go shopping on that because I think it'd be wrong. I think that would be ignoring the underlying trend. It'd be a fantastic buying opportunity. I know gold bugs that are all in, they don't want to hear about more buying opportunities. They just wanted to go to the moon already. Good things come to those who wait. But I've still got money to buy with. And that would be one reason. A general market meltdown would be another way to average down on some stocks. So win-win. I am bullish, but I'd like to have some more buying opportunities to deploy if I could get some.
All right. Well, Lobo, we really appreciate your time today. And I think the name Independent Speculator really fits you very well. When we have you on, it's the opposite of groupthink. We're getting a very independent perspective, and we really, really appreciate that. So independentspeculator.com is the website. Any last thoughts before I let you go?
Just since you highlight that, I have to say for the 3 people who are still listening after you go into the wrap-up mode, you may not agree with me. I may not always be right, but at least you know that I'm telling you what I think. I'm trying to give you the best benefit of my experience, what I see in the markets, instead of just telling you what I think you want to hear. So hopefully that counts for something.
And that's what we want on the channel. So thank you so much, Lobo. And once again, God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.